In today's video, I want to look at a few things and dispel this myth that we are in a deflation or that we're about to begin a bear market in the stocks. Just none of those things are true. There are several things to look for before a bear market starts, and bear markets don't just appear out of nowhere. They need to have a catalyst for the market to go down. Central banks, tend to expand the money supply, so markets, the general tendency is for markets to go up. So without a catalyst, there's no chance of a bear market. So let's look at some of the indicators that would potentially signal that a bear market is about to begin. The first thing I would look at is the advanced decline line. It almost always starts to diverge before a major market top, and then the market rolls over into a bear market. You can see we had a top way back in '98 here in the advanced decline line, and it was diverging considerably into the 2000 top. Not quite as obvious in 2007, but we did have a bit of a divergence here at this double top in late 2007. So the advanced decline line was starting to diverge again, and you can clearly see that we just don't have any kind of divergence in the advanced decline line yet. So we don't have that red flag. So that's one. Often, but not always, the banks will usually start to diverge at a major market top. The banks did actually make a slightly higher high here in 2001, but you can see as the market was churning higher, the banks more or less topped in '98 and then just started to go sideways. So that was a warning sign. The banks topped in early 2007 and were already starting to diverge significantly when the rest of the market topped in late 2007. Again, you can see that we don't have any big divergence in the banking sector. They've been going up right along with the rest of the stock market. So there's another red flag that just isn't flying yet. And finally, I've gone over this before, and I said this earlier in the podcast. There has to be a catalyst for the economy to roll over into recession and for a bear market to start. They don't just appear out of nowhere. And historically, since about 1940, every recession has been caused by or has been preceded by inflation. Usually, always, a strong surge in the price of oil. Oil is the lifeblood of the economy. If it goes up slowly, the price of oil creeps higher, the economy can withstand that. The problems occur when it spikes rapidly, and by that I mean 100% in a year or less. That has triggered a recession every single time it's happened, except for one, and I'll show you here in a second. But that almost always triggers a recession, as it's just too much of a shock to the economy. Consumer spending collapses as it becomes just too expensive to fill up your car every week. And so consumers start to cut back, and usually the price of food and everything else is going up if the price of energy is surging. So when we have a big inflation, then it is almost always caused a recession. So you can see here in '99 to the middle of 2000, oil went from $10 to almost $40. So almost a 300% rise in a very short period of time. With the predictable result, we had a recession in a bear market in stocks. You can see this very clearly here. People talk about there was not any inflation, and that's just nonsense. We've got one of the most extreme inflationary events in modern history in 2007. You had oil go from $50 a barrel to almost $150 a barrel in just a little over a year and a half. Again, with the predictable result, the economy rolls over into recession, and you get a deflation. This is the one time when we didn't really have a recession on a big spike in oil, and I think that's because we were coming out of a deflation right here, and the Fed started QE1, and it just reflated everything, and we did get a rise in oil that was over 100% in just a little over a year, but it did not cause a recession. You can see right now clearly oil is not spiking. There's no pressure on the economy from inflation, but we clearly do not have deflation. This is what deflation looks like here and here, and you can see where the inflation is going. It's just not leaking into the commodity markets at the moment. We have extreme inflation, but it's focusing mostly in the stock market. So until the stock market finishes its bubble phase and goes parabolic and then pops, we're probably not going to get a lot of this liquidity that's flowing into the stock market right now start to flow into the commodity markets. For the time being anyway, the commodity markets seem to be kind of stuck in a range, and I suspect they will be stuck in a range or just modestly climbing until the stock market finishes its bubble phase and pops. And now there's going to be lots of analysts that'll that are looking for the sky to fall, and that will assure traders that we are now in another bubble, and I think we're starting a bubble phase, but we are clearly not in anywhere near the final end game of a bubble, and I do think we will have another bubble. That's been the pattern for the last 17 years. The Fed, they keep running the same monetary policy. Interest rates too low for too long. They print too much money. It's led to one bubble after another, and I think we'll get the same result this time. If you keep doing the same thing over and over, you should keep getting the same result. So you can see the huge parabolic spike in 2000 when the Fed kept interest rates too low too long to protect against the 2000 or the millennial bug, created a bubble in the NASDAQ, clearly a parabolic move, pushed extremely far above the 200-week moving average, and then collapsed. In 2007, of course, the bubble occurred in the real estate market, and as we move into 2018, I think we will get another bubble. I think it will again manifest mostly in the tech sector, but right now, we're getting a little ways above this 200-week moving average, but nothing compared to this kind of a parabolic spike. If I had to guess, I would say we're somewhere right in this area, and we still have this in front of us. I showed this in my last chart of the day, I believe it was. The bubble phase will typically start once the bull market breaks out of its long-term trend channel. You can see back in 99 that occurred right here. It broke out, then it back tested it several times, and then once the public really started to pile in, the market just took off to the upside. So we're close. We've had one tiny little push above the trend channel. We've dropped back below it. I think we're probably getting ready to break through it. So my guess is we break through it early this summer, and then maybe back test this in the fall before we take off into the bubble phase. So you don't typically get this parabolic spike until the public starts to pile into the market. And I've seen some analysts making claims that the public is completely or fully invested in the stock market now, and now I'm going to dispel that myth. In this chart, this is a chart from sentimenttrader.com. I would strongly recommend anybody that's serious about trading markets, you need to have a subscription to Sentiment Trader in order to monitor sentiment. So this chart is a chart of the robo ratio, which is retail only buy to open call and put options. So it's the ratio between call and put buying in retail traders. So this is probably the purest measure of retail sentiment. So you can see at the top in 2000, you can see where the retail traders were massively buying call options at that top. At the top in 2007, even all the way up, you can see retail traders very heavily buying call options, very, very complacent at the market top. Now, we move to the current market, a market which many analysts are claiming that we've got full retail involvement. We've got bubble conditions, and you go and you look at the robo ratio, and you can see we aren't even close, not even remotely close to the kind of conditions that exist at a final market top. The reason being is this bear market right here so damaged retail trader sentiment that it's taking a long time for the public to become confident in the stock market again. That the same thing happened in the 32 crash. It took almost 20 years before the average trader was convinced and willing to go back into the stock market. The same thing has happened here. We had the second worst bear market in history. It has extremely damaged sentiment, especially in the retail sector of the market, and we just don't have the conditions yet that would signal massive public participation in a final bubble top. When we start to get sentiment like this, or even, and this wasn't even a bubble, this was just the bubble was in real estate, this is just a market top, I think we're going to have another bubble. So we may have to get the robo ratio looking more like this when we had the bubble in 2000 before we get a market top. So we clearly do not have full public participation in this market yet by any stretch of the imagination, and I think we will at the top, because I think we are going to have another bubble. Like I said, the Fed just keeps doing, or central banks everywhere just keep doing the same thing over and over. So logic would suggest that if the Fed keeps doing the same thing over and over, we're going to get the same result. We had a bubble here, another bubble here. They've just done the same thing again, only more so. So I think we're going to get another bubble in the stock market, and at some point here, the retail public is going to become convinced that the Fed is omnipotent and that the markets will never fall, and that there's free money to be had. And then at that point, we will get our parabolic move up, and we'll start to see sentiment similar to these last two market tops, and that's the point at which I think we get a final top in the next bear market in the stocks.